So, Tim, your surgery went well.
Yeah, man. The Ninja Goat took me out, but you know what? Couldn't hold me back. Went to the docs. The surgeon said, "Hey, not looking great as far as the healing. Let's go ahead and operate." So, got myself a plate, screws, and guess what? This is a win-win because now I get a card. So when I go through the
Metal
airport
detectors. You're going to
security,
get pulled out of line every time you get on an airplane now.
and I'm going to say, "Hey,
You're
look."
going to hold everybody up.
Yeah, kind of, sort of. Yeah. So now I think I'm going to get that pre-check thing.
Oh,
I think
the
I have.
clear.
Yeah,
I have
yeah.
that.
Yeah, I got to do something because this will drive me freaking nuts, man. I'm serious.
Yeah, it's
Hey,
$168 a year.
damn.
And sometimes you look at it and you don't know whether it's faster, but even 15 minutes faster sometimes is worth it. You know what I mean?
$168. I don't know. Now you got me thinking, Brian. I'm cheap, right? I mean, let's just call
Yeah.
it what it is.
Time is money, though, Tim.
Well, talk about time is money. What is going on with the banks, man? What are you seeing going on?
Yeah, I wanted to ask you about that because you are obviously the guy, the money man. I was planning on coming on here and talking about how interest rates are expected to continue to go up even past 7%. And the
Sure.
numbers just came out the other day showing that inventory is down, the number of sales is down. The one thing that wasn't down, believe it or not, out of all the numbers that are down was prices. In the Maryland suburbs area, prices were not, and they weren't up, but they were just like 0.01% up. And it was basically
Right.
like flat.
So
And I
what's
think
that?
I think what you'd probably see is prices in the 300 to 500K price range might have crept up, especially in the 3 to 4, and prices in the like 750 to a million probably went down. That's probably how it all played out.
And I think just to kind of take it a step farther, I think people in the 750 and higher are deciding not to sell their houses. I mean, you and
Yeah.
I talked about that last week. They realize, you know what? Why should I sell my house? What am I going to buy? Whatever I buy, the payment's going to be twice what I'm going to be paying, right? Interest
Right.
rate
Right.
twice the payment itself. Taxes are going up, and I'm just not going to get the house for the money. So I think what's happening is the high end is pulling out of the inventory.
Yeah.
I think the middle and the low section is still there. I think the low section, the affordability, Brian, there's such a huge demand from an affordability standpoint. There's just not enough houses. So yes, I concur completely. I think values are going to maintain stabilization in our area, not the West Coast. West Coast is seeing something different, right? So I think that's number one. That's a huge factor. Yeah, interest rates play a huge part. And I hate to say this, but we had a major challenge last week with the I don't want to call it collapse, but the Silicon Valley Bank, shutting down its doors.
Yeah.
Signature Bank, another bank being shut down. And I think we need to talk about that because that's actually, you're going to laugh. You ready? A good thing for interest rates.
Yes.
Okay.
So let me ask you a quick question, Tim. Like, does the Silicon Valley Bank or Silicon Valley, I don't even know what the right way to sell it. People say it differently.
SVB, yes.
Okay. SVB.
Right.
Did crypto have anything to do with that or any sort of like weird venture?
And I think you nailed it right there. So this is not 07, 08 when the issue, what caused the cause and effect was bad mortgages, was bad debt, okay, bad lending, right? That's what triggered the collapse of the banking industry and the collapse of the large financial institutions. In this case, it's the collapse of the cryptocurrency exchanges themselves.
Really?
Yes. And so what's happened is the banks were lending, they had loans out, lines of credit, et cetera, to these huge crypto exchanges, right? And in return, these crypto exchanges have basically went belly up, right? They defaulted. There was fraud involved. There was a lot of issues, and come to find out, it was like the king wearing no clothes riding the horse. It wasn't what they thought it was, right? And so what's happened is these loans began to go bad. Well, when you're lending money to these institutions at 3, 4, possibly 5%, and you expect to make some kind of a positive return on your money, right? And then you're borrowing money at 0.25. From a savings account standpoint, you would think, okay, you know what? Good spread, 0.25. I'm paying my savings and checking account clients. I'm collecting 3, 4, 5%. It should be good. Well, when this collapse occurred, the people who had money in the bank said, geez, and they pulled their money out, right? So we're seeing all this savings and checking. Well, where does the bank go to replace that money? The Federal Reserve. And what is the Federal Reserve charging right currently in interest rates for their overnight money?
I see.
5 to 5.25%. So now I want you to think about this. I have loans at 3% and 4%, which were a good return. I have treasury bonds as an investment that were paying 2% last year, which was a high rate of return. And I'm thinking, I'm in like Flynn. Well, now your cost of money has gone to 5.25. Your return on your money is 2 to 3, and now you have a loss of 2 to 3%.
Is there a risk of that happening to other people? Because that doesn't sound like that's particular to SVB.
No, so here's the key. Ready? There are a number of banks that were exposed to the cryptocurrency. But now here's the kick. Here's where it really starts to happen. As the Federal Reserve continues to raise the cost of money and we get into recession and people pull out their savings and checking to pay for bills, and the banks have less money in the bank, they have to borrow from the Federal Reserve. They're borrowing from the Federal Reserve at that 5, possibly 6%. They're only collecting 3-4% on their loans. They're taking a loss on billions of dollars. So now it's not just the crypto that triggered the challenge, triggered the issue, right? And now it could fall through, it could feed all the way through. Now, Brian, this is a good thing. Why is it a good thing?
Well, it's you're gonna say it's gonna potentially cause the Fed to then lower the rates in order to be able to phase or stave this off, and that's going to lower interest rates for mortgages.
The Feds have to stop this game of we're going to try to control inflation by if you will, raising interest rates, because they've already done it. It's already happened. It's just a matter of it's a slow process. You don't turn a cruise liner around,
well, they did. I mean, they turned it around in a year. They went from 3 to 7 in a year, less than a year. They did it in 11 months.
And what happened to the
well, it messed up the real estate business. Obviously, has messed up the banking industry. So you're saying that if they raise it more, it just creates too much stress.
Well, it's going to cause stress in the banking industry. Right. In return, if the banks get ultra conservative, they stop lending money.
So they don't care if they mess up the housing market, because they probably figured we were probably overinflated anyway, and that we were probably running too hot. They needed to cool us off.
So think about this. So number one, they're trying to stop the housing market. Well, here's the problem. There's not enough houses right now to support housing needs in general. They're 10 years behind building new homes, and what they're building is so damn expensive that nobody can afford it, right?
Well, I just interviewed Brooke Kane yesterday, and we had this discussion in the beginning of our conversation about, that and that there is it's a statewide, he calls it like a moratorium. Essentially, they've put so many regulations in place on purpose,
right?
Because they don't want new construction, especially in Southern Maryland, but they're even in other parts of the state compared to other states. The argument that I made was that there's not as much, ground to develop here. That's like new ground. Like if you go to places like Texas, they're sort of just inventing cities, and they're just expanding out into the suburbs that weren't typically suburbs, like Austin and Dallas and Houston. They're going farther out and creating new cities. But in Maryland, this is a very old place, and that the ground's already been developed. But his point was there's plenty, and especially in Southern Maryland, right? Mm-hmm. There's plenty of ground that could be developed.
It's a regulation.
They don't want it. They don't want new houses here. And that's, from what I understand, also an issue around the country. People don't want traffic. People don't want the, just the hustle and the bustle. And like they're sort of used to a way of life. The idea of adding a lot more people to the area doesn't necessarily sound more pleasant. I would say if it's done in the right way, it could be. I like where I live in Lusby as an example. When they developed St. Mary's County across the bridge, they put in a lot of the stores that people like to go to, so it makes life a lot more convenient.
Sure.
And the traffic's not really that bad compared to like as you get up to DC. it's nice to have a Starbucks near your house and an Ace Hardware where you can go in there and get stuff, and an Advanced Auto Parts within 3 miles of your house. That's a luxury for me, growing up where there wasn't always that available.
So back to the banks. So the banks, are right now freaked out. There are several banks that were put under the watch. Moody's just downgraded a number of banks yesterday. So we're seeing this major trifecta effect now, which is actually, in my opinion, going to cause the Feds to put the brakes on raising rates. And in fact, what we've been predicting all along is actually a cycle back to, better interest rates, better being hopefully in the 4s and the 5s.
That would be fantastic. What I feel like needs to happen is they need to do it over a 3-year period. So allow people to transition out of their mortgages that are at 3% into 4, and then out of 4 into 5, and out of 5 into 6. Like, you know what I mean? If you want to go there, that's fine. If it's necessary to keep the economy where it needs to be, but doing it all of a sudden, such a big jump, it just created, and then that paired up with the house prices going up so fast, it doubled the mortgages, and it just created a situation where it's also very expensive compared to the household incomes. The houses are just expensive, period, just compared to what they've always been. You know what I mean?
Now let's take that one thought right there. You said 2 things to me really important. You said values are stabilized. Right? In Maryland, at least anyway, right? They're trying to expand in areas that have availability where the regulation isn't as bad. Texas, we talked about that. Now, the other thing I read was rental rates were expected to go up between 5 and 8%. And yet I saw an article over the weekend that said now they're expecting up to 20% due to the interest rates. So interest rates, people saying, I'm done. I've given up. I'm not going to go out. I'm going to go ahead and just lease for another year. Landlord saying, hey, sorry, got to raise my rates.
Well, the other thing that's happening is people that wouldn't normally rent their house are renting their house. So I feel like it's the same thing back in 2008 when people rented their house because they couldn't sell it because they were upside down on their equity. There was a lot of people that I sold their house in 17, 18, and 19 who had bought their house in 8, 9, 10, 11 who couldn't sell it because they didn't have equity, or even 04. They were it took from 04 to 19 to get out of some people's houses.
So I don't think people are renting though because of that purpose. I think people are renting because they're looking at, you ready? Real simple, vacation rentals.
Well, I think it's because they're sitting on a 3% interest rate they don't want to give up. They find and now the delta between the mortgage and the rent amount is very, very high. Like before, it used to be maybe, make an extra $100 on top of your mortgage. Now I'm talking to people. We talked about this a couple weeks ago. Renting a Section 8 house in PG County. It's like they're getting $5,000 a month. She says my mortgage is only like $2,500 a month. I'm making $2,500 a month.
Win-win. So what's that going to do to the inventory? It's not coming back, Brian. Values are going to be not stabilized. They're going to continue going up. I mean, I've always been positive about inventory. I'm looking at inventory. Inventory is not going up. Okay. Because
I know it's not. It's going down.
Right. So what's that tell you about values? So values are going up, number one. Number two, I think interest rates are going to come down because the Federal Reserve is going to be forced to bring rates down because they don't want to see the banking industry crash. That's all there is to it. So force, and the Feds need that. It's the only way the Feds are going to have to justify bringing things down. So rates are going to come down. Inventory is going to continue gradually going up. It's still going to be a challenge in this industry, in this marketplace. Affordability is going to return slightly, not a whole heck of a lot, but we're going to see a little bit better return on the interest rates. And quite honestly, go back to the whole story. Housing is still a central theme of the United States financial system. And the government recognizes we got to do something because we are in a little bit of a challenging period of time, right?
Well, last year we were in a little bit of a challenging period of time. Everybody sort of was feeling the heat of what was coming. And we are way off last year. Across the board, we are like 30% off. I just want to spout off some numbers real quick. So I got a headline across from the MLS directly from the multiple listing service. This is the service that all houses go into that are for sale.
Right.
And key findings, Washington, D.C. metro area,
Huh?
the number of new listings, and this is year over year from
Yeah.
last year. This is
Sure.
February. So this is
Yeah.
like recent data, right? And
Right.
last year was already off the year before. I think it was, 20 or 30% the year before. It's down 36% fewer new listings.
Wow. Okay. See, that's
The number
huge.
of sales was down 24%. The number
Okay.
of showings was down 40%. The new pending sales down 28%. And here we are, median sales price up 1.7%. I thought it was 0.7, but it's 1.7%.
And why is it? Because the high end is getting out of the marketplace. Number one, you and I both have talked about that, right? They're
Yeah.
getting out of it. They're saying, you know what, I'm done. I can't afford to buy, or it doesn't make sense to sell, or I could turn my property into a rental property. I think it's number one. I think number two, the other side of the coin, the people at the higher end, honestly, where are they going to go? Where are they going to afford to buy, right?
The only people that I know that are doing it, and I have I have 4 people moving to Florida right now that I'm selling their house or have already moved to Florida.
Hey,
But
you nailed it right there.
so it's
Yep.
people that are retiring they're cashing out. So they're cashing out their equity and they're buying a house in cash. But I don't have anybody who I'm selling their house right now who's selling a house and buying a bigger one. I couldn't even tell you the last time I sold somebody's house they could buy a bigger one. It's probably been 12 months.
So you see what I'm saying again. I think I think inventory as a whole is just going to be flat, if not declining. I think people are realizing it's cheaper to rent. I think there's a huge demand for rentals. So all in all, I think this is the trifecta for buying right now, because I think the values are going to continue going up. I think interest rates are going to come down. I think it's a win-win on all occasions. So I'm fired up, man.
Yeah, I agree. I think it is the best time to buy and the best time to sell, to be honest with you. Because like you said, I think house prices are going to hold, and you can always refinance down, and you can lock in if rates are going to go up. So it does make sense. And there is value in, like Tim and I have talked about 100 times, the 4 savings of having a mortgage. You get the tax write-offs of having the interest write-offs. And there's also something about the mental state of living somewhere that you own and having like a base instead of the idea of renting. One of the biggest issues I have is people call me up because the people that they're renting from decide to sell their house, and there's no guarantee. Year over year, you have to sort of renegotiate everything, unless you're in a long-term lease, which most people are not. So that's it, Tim. What else, man? Anything else exciting happening?
Yeah, I mean, so we talked about this. We talked about interest rates. We talked about the marketplace. I will tell you one thing I am seeing, which is kind of wild. From a competition standpoint, I thought things would get a little less competitive. The investor side, dude, it is nuts right now. I got so many people buying properties with the intent to flip.
Yeah, so I have people that are asking me about the same thing, and I'm telling them it's tough out there to find opportunities.
It is tough, but I think they're there. I mean, I just did one, so I'll walk you through a really fast illustration. I got a client who's looking at a house for $205,000. The house is a dog, D-O-G. You know what I'm talking about? And it needs a good $70,000 to $80,000 worth of work.
Right.
So now we're talking 205. At 80, I'm at 285.
Yep.
But the house was fixed up itself for 450.
Okay, so did you hook them up with an investor to flip the house for them, and then you're just going to hold off on it and do the loan when it's all done, type thing?
Well, so in essence, I've hooked them up with. So they're writing a contract for the 205. Okay, they're getting their estimates for the $80,000. That's kind of their initial number.
This is not in Prince Frederick by any chance, is it?
No. This is in Charles,
all right.
and it's actually in La Plata.
I just saw one the other day. It was like this.
So think about it, Brian. So 285. Okay. But here's the key. And this is what we're talking about. People don't understand that, look, when you get into a flip, you do have to burn the boat. It is a lot of risk. You got to know what you're doing. And that's one thing I caution people about flips, right? They're using hard money to get into it. Okay. Hard money is expensive. I mean, we're talking 12%, couple points. I mean, that's pretty typical. They're lending against a certain after repair value, right? So they're lending to 60 to 70%, depending on your experience level, your credit, et cetera, and what you have into the deal. But the margins are still there. People are still making 50, 60,000. I mean, plus it all comes down to what kind of house you can create because of that severe lack of inventory.
Yeah.
So where do I think this year is going to be all about? Ready? 65% is going to be first-time home buyers. I think solid, out of the box. That's who's buying. Pent-up demand. People need housing. They don't have a choice, right? That's number one. I think, quite honestly, you're going to see about 15% move up. There's still a need. You know, I need to get closer to work. My family is exploding. I talked to a contractor the other day. He has more home improvement business lined up than he can handle.
Yeah, it's been that way for a while for those guys.
65% first-time home buyers, 15% move up, 20% investment. People buying for rental return. We talked about that. People buying for vacation rentals because they realize people aren't going to be selling their house, so they want to have more experiences outside of their home. And then people buying for flip purposes. So that's
and I have some investors. If anybody wants to sell their house cash, call me or Tim. Both of us have investors that are looking for opportunities out there. So that's definitely a thing. But
Brian, it's going to be a great year, man. I'm serious.
No, it is. My numbers are up, Tim, but that's because of my niches, helping people whose houses didn't sell the first time. So overall, the numbers are down. A lot of real estate agents and lenders are out there suffering. Title companies are out suffering. But I think that there's going to be a little bit of like a release once the interest rates bump down. You're going to see a huge bump. Like if they were to somehow tap 5.9% interest rates like this happened a couple of weeks ago, you're going to see rates shoot. So rates did improve. And this is what I want to finish up with. You said that rates are going to get better or they have gotten better.
They're actually slowly getting better. Last 3 days.
I read some headline last week that they went 100 basis points in one day, the day after the collapse. Is that true?
Yeah, not true. So what happened in essence, and this is kind of crazy. Of course, somebody's calling now about the interest rate. See what you do to me, Brian? They're like, hey, we want to get in. Now, what happened was we saw a 100-point swing on the 5.5 Fannie Mae traded mortgage-backed security. Then we lost a bunch of it at the end of the day. But slowly, here's I'm going to leave you with this image. You ready?
All right.
The 10-year Treasury, okay, which is what we watch, was over 4% as of Thursday, that blew us away. Okay. Right. Today we're down to 3.4. So Treasury rates are coming down. That's a sign that long-term rates are going to come down. That's phenomenal. Meanwhile, unfortunately, Dow Jones Industrial Average down 500 points. So stock market's going to take some crumbling. Stock market's going to get hard with this bank issue with the feds, okay? Right. Because businesses can't borrow money. They can't borrow money. They can't reinvest in the marketplace. So what's going to happen at the end of the day? Yes, you're right. Interest rates are going to come down. We're already starting to see the effect. It's going to trickle down. It's going to happen because the other side of the coin, the banks, the mortgage companies are freaked out at the same time because they've got commitments to people at 7%. I saw 8%, last couple of weeks.
You and now somebody at 8%, Tim?
No, I did not. But I saw somebody called me and they said, hey, my rate's 7.875. And I was like, what are you doing? And then when I sat down with them and I went through all the numbers, I said, this is a little aggressive. It was an investment purchase, which you and I both know is higher interest rates. And they were only putting 15% down. So that was the reason.
How much down? 15%?
15, yeah.
I didn't know that was a thing. I thought you needed 20.
High score
credit.
High scores, high credit scores, reserves. There are some really benefits. So Brian, we're not out of the woods, but my point is, if you're creative, if you're imaginative, if you're positive, if you're focused, you watch the market, dude, you'll make it happen, man. Seriously.
All right, Tim, I appreciate you, man. I'm glad your arm is okay.
I'll say, watch the ninja goats. I'm just telling you right now. I did not realize
don't get goats. That's my advice. My advice is don't stay away from farm animals. Tim, you're good at lending. Let's just stay in your lane, brother. You know what I mean?
You know what? I made a very important lesson there. Watch
Yeah.
them
Let the
go.
farmers handle the goats, man. You know,
You ever
what I
seen
mean?
their eyes?
You're not Yellowstone,
Yeah.
all right?
The goat's eyes are kind of weird. You look at them, you're like,
Yeah,
there's
they're
a
from the
reason.
devil, Tim. That's why I don't mess with
No,
those
no, no,
things.
no, we don't want to go there.
Man.
All right,
All
brother.
right, man.
Talk to you soon.